Picture this. You've made it through the initial screenings, right? You're sitting in the hot seat across from a hiring manager for an Accenture Record to Report or R2R financial analyst role. Your heart's probably beating a little fast. They glance at your resume, look back up at you, and they ask a fundamental yet incredibly revealing technical question. How you answer in the next 2 minutes, well, that could literally be the difference between getting an offer and getting a polite rejection email. Today, we're dissecting the exact source material you need to not just answer, but completely master one of the most critical accounting interview questions you'll ever face. We are going to turn the core concepts of asset accounting into your ultimate competitive advantage.
So here's the question you need to be ready for. How does straight line and accelerated depreciation differ? Now, on the surface, I know this sounds like accounting 101. You might be tempted to just rattle off a textbook definition and move on. But remember, we're talking about Accenture here. They aren't just testing if you memorize the textbook. They want to know if you understand how these concepts actually operate in the real world of corporate finance. The stakes are high. You absolutely need to deliver a knockout, practical response rather than just dry theory.
Okay, let's dive into this. Straight line depreciation. This is considered the absolute simplest and honestly the most frequently used method out there. By definition, it allocates an equal, steady amount of depreciation expense to each accounting period throughout the asset's entire service life. It's the baseline. You've got to establish this standard before comparing anything else to it.
Think of it like a perfectly flat, predictable expense over time. The logic here is based entirely on the assumption that an asset provides economic benefits evenly. Say a company buys an office building, some furniture, or general equipment like computers. Their utility typically declines at a very steady, predictable rate. An office desk is just as useful in year 2 as it is in year 1, right? Because of that, the expense recognized remains exactly the same every single year.
Now, you do need to know the technical foundation, but the math is super straightforward. The annual expense equals the acquisition cost minus the estimated salvage value, what'll be worth at the very end, divided by its useful life. So if a company buys a $100,000 asset with zero salvage value to be used over 10 years, that's $10,000 of expense recorded every single year. Consistent, reliable, easy to track. But as you know, not all assets behave this way in the real world.
And that brings us to the other side of the coin, accelerated depreciation. Methods like the double declining balance completely flip the script. Instead of a steady drip, these methods literally front-load the expense. This means you're recognizing a much higher cost in the early years of an asset's life, and that expense gradually decreases later on. It's an aggressive, upfront approach.
And this brilliantly illustrates why a company would do that. Why recognize a massive expense up front, followed by sharp step-downs? Well, because it reflects reality. Think about specialized machinery or a fleet of delivery vehicles. A delivery truck loses a huge chunk of its economic value and productivity the minute it drives off the lot, and through those first 100,000 miles. It requires way more maintenance later on, so it makes total sense to recognize the bulk of its cost up front while it's highly productive.
So the strategic why behind accelerated methods is really twofold. First, like we just said, it perfectly reflects actual usage patterns for rapidly depreciating assets. Second, and definitely bring this up in your interview to show real business acumen, it can offer major tax advantages. By allowing for larger deductions earlier in the asset's life cycle, you improve near-term cash flow. But there's a trade-off. It's way more complex. As an analyst, you have to actively monitor the assets so the book value doesn't accidentally drop below its salvage value. You can't just set it and forget it.
If you want to absolutely nail the theoretical part of this question, keep this mental cheat sheet ready. For the expense pattern, straight line is equal every period, while accelerated is high early, low late. For asset suitability, straight line is for buildings and stable utility assets. Accelerated is for machinery and vehicles that lose value fast. And for complexity, straight line is incredibly simple, but accelerated is complex and requires strict tracking. If you can articulate those 3 contrasts clearly, you've won the first half of the battle.
But right here, this is where you separate yourself from the rest of the pack. A good candidate stops at the theory. A great Accenture candidate, the one who actually gets the offer, makes a value-add pivot. You transition from accounting theory straight into SAP S4HANA execution. Because at a firm like Accenture, you aren't just doing math on a whiteboard. You're operating inside massive enterprise systems. You need to show them you know how this actually gets done.
In an operational environment like Accenture, these exact depreciation methods are managed within ERP systems, specifically SAP S4HANA. You'll be operating inside the FIAA, or Fixed Asset Module.
Trust me, when you drop that specific module name in the interview, you instantly prove that you understand the actual environment a junior financial analyst works in. You're speaking their language now.
Let's move to Dolio and see how this builds your operational workflow, because you definitely aren't calculating every asset by hand. Step 1, you check the asset master record to ensure the correct useful life and depreciation key are assigned. That key is what tells the system whether to use straight line or accelerated. Step 2, navigate the FIAA module. Step 3, execute the monthly run. And for the ultimate technical knockout punch, tell your interviewer you execute that monthly run using T-code AFAB. Knowing the exact transaction code shows you are literally ready to hit the ground running.
So, the crucial point is synthesizing all of this into one perfect answer. You should memorize this. Straight line offers steady expense for stable assets, while accelerated front-loads costs for fast depreciating ones. Operationally, I manage both in SAP's FIAA module, assigning the right depreciation key to the asset master before executing the monthly run via T-code AFAB. Just like that, in 2 sentences, you cover the concept, the business rationale, the software module, the master data requirement, and the specific transaction code. That is an unbeatable answer.
We've covered the theory, the strategy, and the technical execution. You now hold the absolute blueprint to demystify depreciation for your interviewers. So I'll leave you with this. When you finally sit down for your record-to-report interview, how will you use this SAP workflow to prove you're not just a student of accounting, but a ready-to-deploy financial analyst? Think about how you can confidently apply this exact structure to ace your career goals and completely stand out in the hiring process. You've got this.